This is Ryan Coombs, Vice President of Research and Strategies at Carty & Company. Here's your weekly market update ending the fifth Friday of January 2016. In the economy, the Federal Reserve kept benchmark interest rates pegged at 0.25% to 0.5% as expected. The Fed did make a key change to its statement clarifying that it would be closely monitoring developments in the global financial markets. The phrase closely monitoring usually points to a Fed that is quite concerned about the current events, and in this case, the global markets. The U.S. economy expanded at a slower pace in the fourth quarter as households tempered spending and businesses cut back on capital investments. Gross domestic product slowed to a 0.7% annualized rate in the last quarter of 2015 after a 2% gain in the third quarter. That advance was in line with forecasts. In housing, pending sales of existing homes rose 1% in December, much lower than expected. This is the second weakest level since January 2015. The slight increase may mean last month's record jump in actual closings of existing home sales could be more of a reflection of federal regulations rather than strong housing demand. In fixed income, the majority of the market no longer expects another rate hike in March. Derivative traders put the chance of just one rate hike at 60%, a far cry from the 4 increases projected in December. Government bonds across the world climbed on Friday after the Bank of Japan unexpectedly adopted a negative interest rate policy, just days after saying it wasn't going to consider such a move. Treasuries are rallying in January for the third year in a row. U.S. government securities have returned 1.8% this month through Thursday based on the Bloomberg U.S. Treasury Bond Index. They handed investors 3% in January 2015 and 1.8% in January 2014, both the best monthly performances of those respective years. Bank of Japan's monetary stimulus and some key earnings reports helped the U.S. stocks trim their worst monthly rout since 2010. The Dow Jones Industrial Average rallied more than 270 points on Friday. Microsoft rose 5.4% on news of good sales for its suite of internet-based tools. Honeywell gained 3.9% as aerospace sales increased. Amazon.com tumbled 7.8% as earnings for the holiday quarter missed estimates, and Chevron Corporation lost 1.2% after its first quarterly loss since 2002. Last week was volatile for stocks. Investors are trying to find the balance between earnings, intervention from central banks, and the dimming outlook for global growth. The S&P 500's price versus estimated earnings ratio has now dropped to the lowest level since October of 2014. This is an important valuation we will continue to keep our eye on in the coming weeks. That sums up your weekly market update ending the fifth Friday of January 2016. For more details, please visit our information center at www.cartyco.com, and for real-time updates, follow us on Twitter at Fixed Incomes. Thanks for watching, and have a great week.